All right. Good morning, everybody. Spot gamma levels for today. Just let it sit there for a moment so you can catch a screenshot. All right, yeah, pending home sales. That's really the biggest one on the docket today, and then some additional auctions on the later part. So we do have some Fed speakers today. Barr is going to be out chipping teeth, and then later in the day, Bank of England and European Central Bank speakers. But it gets late enough into the day that I don't think those Fed ones are going to hit us that much. So if we look at how things went around the world, Asia kind of kicked things off, faded back later in the day. It's 12:30 in Europe. We got an inside day breakout, and so far, that's a bullish Romney. No wick, just straight push, very aggressive, nice. If you think about how yesterday ended for them, just a real nice reversal. If they can get up a little bit higher, start to trigger a bunch of stops at this level, could actually manage to get all the way back up to the top. It'd be a nice expansion on the day. For crude, we start to zoom out and we can see that we're back inside this box, solidly back inside the box. Working on an inside day breakout from yesterday. But, if you look at what we've done over the last week or so, yesterday was just like a nothing. And so far today, got nothing again. Really looks like a wait and see, which I mentioned yesterday multiple times. It seems like the market is really looking for a new narrative. It doesn't know what to do. It doesn't trust the Fed, doesn't believe the Fed. When the Fed says, we're not going to cut, not this year, it's not happening. And they don't believe it. Don't know what to do with it. On those auctions, we have an 11:30 auction and then a 1 o'clock auction, the 2-year and the 7-year. We do have the EIA petroleum status report today. It does tie in directly with inflation, right? With the cost of energy, how much there is, get some data on the SPR levels. And so I don't want to say it doesn't matter, but its impact in the market is usually more gradual, right? So we would get that kind of data and through the rest of the week start to see its effects. You can often get a little bit of a spike or a bump when the report comes out in the rest of the market, but usually it's a slow build afterwards. You can see the volume is consistent. We're within normal levels, nothing out of line here. Really nice reversal off of the lows yesterday. I called that, by the way. Always nice when you get one right. You call the lows and it just runs you over and keeps going lower. Well, that's never any fun. They say broken clocks are right at least twice a day. So, that was one of mine. We are finally outside of this range that we started this week. Whether we keep it or not is a completely different story. And as you can see here on the daily chart that I've got here on the left, or excuse me, on the right, we're coming up into a critical resistance. 40.39. It's a significant level. I don't know if we're going to be able to get through it or not. And if we do, it's very likely going to come with a catalyst or a push. Well, we just looked through the econ, and there's really nothing in that econ that suggests we're going to get this catalyst or push from that direction. So it's going to have to come from somewhere else. Something to consider. $40.83 would be another really critical level. $40.50, the same one that we've always dealt with. So 40.40 and 40.85, two levels of concern. The ADR right now is 1.9%. If we think about where we closed last night, which is now at the bottom of my screen, this is how far we've moved in the overnight hours. And it seems maybe a bit extreme, but we're only up just a little more than 0.75% this morning. And 0.75% really isn't all that much. We tagged that critical level that I just mentioned, and we've pulled back from it. So, what's the chances that it's going to continue to pull back? Well, markets don't run straight up, right? And when they do run straight up, they fall right the heck back down again. We need a market that pulls back. It should have a consistent, persistent directional trend to it. So if it doesn't pull back, it's not going to be healthy. The question becomes, how much of a pullback should it have? In technical analysis, 786 is that line in the sand, and that's 40.26 for the current run. Now, old school technical analysis, which I'm not a practitioner of because I don't believe in what I'm about to say, they like the 618. And I get it. Back in the day when you were running, say, 30-minute delayed data and it cost you $2,000 just to get that, and you had to trade in a group because you couldn't afford to have, that kind of data feed on your own, people would use 618 for a pullback because, well, I mean, data was delayed. You worked with what you had, and they would tolerate a pullback of that magnitude and consider it acceptable. But in the modern world that we live in, where you get, access to charts for free, you don't have to buy the data, seeing a market pull back all the way to 618 is completely inappropriate. I wouldn't want to trade long off of 618, because where's all the happy, aggressive, exuberant buyers that should have stepped in long before we got to 618 to continue this rally to the upside? They should have came in by 786 at least, because the pullback is nothing more than the transition between those that are happy with the trade they took and they're getting out, and others that are willing to take their spot to continue the run. If we pull back all the way to 618, I find that to be a lack of enthusiastic participants, and I would not trust a rally back up. Now we're talking intraday stuff though, right? We're not talking like weekly charts, monthly charts, long-term trading, big time frames, just this intraday. So 786 is my line in the sand. I wouldn't want to see it pull back more than that, right? And I've stuck to that level for a couple of years now. One of the things about technical analysis that you really have to find is consistency. You can actually do it a million different ways and it won't be wrong, but you have to do it the same way every time for it to be right. So pick a level. I like 786. That's what I'm going to use. And then make that your level from then on, and don't swap back and forth. So it should be appropriate. It would be appropriate to see a pullback to 40.25, tag that 786, continue on to the next level, which would be 40.53, that we had already pointed out is critical resistance on the daily chart, 40.53. And by the way, when you do that, when you draw a level using one tool and you find that it is in confluence with another tool and you're getting the same reading, that's a way to avoid inherent bias, right? They call it the echo chamber in politics, or a multi-collinearity effect in indicators. So it came up with 40.53 as resistance from multiple sources of data. If I had drawn the Fibonacci wrong, it wouldn't have lined up with that level. A little bit of a heads up. We have an MDP this morning. So MDP is a missed daily pivot. We haven't hit the pivot this morning. We ran away from it without ever coming into contact with it. There's a strategy behind that. It's not mine. I didn't make it. I didn't name it. I have nothing to do with it. But if you learn that strategy, you can actually use it for your analysis in the market, because there's some weight or connotation behind the idea that we haven't hit that pivot. We also tagged and managed to rebound through the weekly pivot. So we're back above it and we're expanding beyond it. That gives us a bullish bias, not just in this market, but across the market. The problem, though, is that we still have this range or this zone that we need to get out of, including the ADR levels. $40.44 is the ADR half. That would line up with the top of this box. And if we do get an expansion outside of this box, the full ADR is 40.83, and that gets us just outside of that box. They say 2023 is going to be the year of sideways, and you can see why, right? One into another, and then into another. If I was to keep going, we're just nested inside of all of these ranges. I had opened a short call on the MES the other day, closed it for 50% profit yesterday on that nice little dive to the downside. Still got the put side, which likely is going to be closed today if we manage to break out here and get a nice push to the upside. And then we'll reset and do it all again. $10-day, 30-minute volume profile. So the point of control held. We managed to rebound off of it, headed back towards the top of the box. Throughout the day today, we're going to lose this volume from back here. and that will bring the bottom of this box up to this double bottom. And if we don't expand today out of the top, we're going to have a pretty narrow box, about 100 points, excuse me, 200 points. Call it 4080 to 3080, 3090, 3890. We could say 39 to 41, right? Just kind of cut through all the noise. Yesterday, the TPO point of control was lined up with the volume profile point of control, and it shifted up a little bit yesterday. We don't have a classic shape at all, and we don't have any air pockets of risk really to worry about. There's nothing overhead though, right? But we wouldn't call that an air pocket necessarily, not when it's overhead. We have another VPOC now stacked underneath us. It's really close to 4,000. You can kind of haggle over, you know, a point maybe, but not really worth it. If we did break back down through the Globex run, the cog line at 4015 has some weight behind it. So we could maybe stabilize a little bit around that 4015, 4011. But for a topside breakout, there's really nothing there to hold us back. So when we make a good fast run like that, one of the questions we want to ask is, have we traveled too far? And is it going to mean revert on us? Trying to find the mean is not always an easy thing to do, but I like to use the 10 period moving average for that. It simulates the mean really well. So if we think of the mean as the average or as the center of a basketball court, you start the game, you're in the center, you have full court to the left or to the right to reach your goal, but you're still starting in the center. You're not handicapped from one side to the other. The zero line of this indicator would be that it's where the 10 is. So when we're looking to answer that question, have we moved too far, too fast? Are we going to mean revert from having moved so fast? Are we overbought? No. And this tells us we're not overbought, that we're okay. Got plenty of room. We haven't even moved 1% away from the 10 yet. And the average turning point where the market pauses and lets the 10 catch up, or the market reverses and comes back towards the 10, that usually happens past 2%. If we're looking for the average of that reversal. So plenty of room. Another thing that we can look at is where the weekly expected move range was. So for the entire week, we were projected to move somewhere within this box, but that we would stay in the box. That was the projection of the week. And a lot of times we'll get to the edge of the box, maybe shoot through it like we did last week, and come right back inside the box again. Statistically, we're going to close inside of this box 80% of the time. It's more than a 1 standard deviation of accuracy. It's pretty good. So we're not at the top of the box. We're not even near the top of the box. Got plenty of room. We're not overbought. We haven't moved too far, too fast. And the market is not likely to mean revert on those bigger time frames. In the shorter time frame, after making such a run like this, yeah, we're due a little bit of a pullback. But 40.25 is kind of that line in the sand. Really shouldn't pull back more than that. And if it does, we can start to maybe get a little concerned. One of the things about having an IX10 pattern or an inside day is that we can project that level. Lines up at 40.53, which is really close to that 40.52, right? Right, just lines up really nice. So it's the same critical resistance level that I already had marked. And it's 50% of the range that we just measured. Right, this is what I measured. Monday's candle. So we take Monday's candle and we plot it to the upside. 50% is 40.52, just round up and say 40.53. And all of it plotted up is 40.71, which gets us really close to the top of this line here, 40.73. Again, when all your measurements line up and you're getting them from different sources, you know you're doing it right. All right, Bitcoin and Bitcoin proxy products are leading the run this morning. Right behind that, semiconductors. Oddly enough, energy, and then finance, and then more energy and some technology far down on the beaten path. We should see KWeb way up here with the rest of these, but we're not because of the Alibaba pullback. It has enough weight in there to pull that thing down. So this is a broad sector rally, though. You know, the other day when we had a pretty good push, it was finance, Asian tech, and that was really like the two, oh, and Bitcoin, right? The Bitcoin proxies. So those three were really all that we had the other day in the rally. Today we have industrials, building materials, energy, oil exploration. It's a rising tide lifts all boats kind of rally instead of 2 or 3 sectors doing all the heavy lifting kind of rally. This is a tech driven rally for sure. We're getting those pushes in semiconductors again, along with the NY Fang names. Microsoft, Apple, Amazon, Snow, which I'm still I'm still trying to get comfortable with that one. AMD is now in the fangs. I'm still not happy with that, but you know, it's maybe I just don't like changes. So all those are up this morning, along with energy, crude, All right, so JD took a gut punch, nice drop down this morning, big gap to fill. Baidu got a really nice bear pennant this morning and a gap. PDD had already gapped down or dropped down and has already recovered. That's looking really good. 73.5 is a level that it really needs to get through. But if it does, I mean, we could easily get to 80 in this thing, no problem. Especially after that nice compression for the last 2 days. And it's already up again this morning. So when we talk about a TRB setup, that's a really nice setup. Look at the graveyard doji candle from yesterday. So there's the setup right there. 3 candles down, fourth one sets that low, rallies all the way back up. That was an inside day breakout close yesterday, and it closed red. Sure, right? It's a red candle because it closed lower than it opened. But if I was using the other candle style, it would be green because it closed higher than the previous day's close. So we're looking for the follow through here in this TRB setup. That's our recovery candle. The follow through candle is target to get back to the range top. Now, if you want to be a little less aggressive, 50% of that range top. So 78, 75, maybe 79, right? 78.75 or $79. That'd be the price target. Easily hitting that price target, right? That's why the TRB is so cool, because the follow through candle is a monster. Doesn't have to be. It doesn't always get to be that monster candle, but very often it's a nice little 3-bar. Without this, doesn't have the recovery candle like that recovery candle. And look at that next day. So you can see they're not always so awesome. But yeah, PDD looks good today for a nice little TRB setup. I'm gonna keep it. So we can see on the KWeb that it's not quite back up to where it dropped off, but it's recovered pretty good. And for the Bitcoin proxies, a lot of those are semiconductors. We've been using the Smalls Exchange futures ETF. It's not really an ETF. It's a ETF. I don't really know what they just used to describe those smalls, but it's a basket of stocks, right? Any other way you put it, it's a basket of stocks. So we took the Smalls Exchange futures product, opened it up, and looked at the names that were inside of it. And that's where the watch list for my crypto comes from. It's from that Bitcoin Smalls Exchange. So these names, a lot of them are semiconductors. When we see Bitcoin up in the mornings, one, Bitcoin's like the riskiest thing you can trade. So it's an indication of risk that the market is feeling frisky. Those animal spirits, the market's looking for risk opportunities, and it's going to trade into Bitcoin. That's one reason. But it's also a liquidity tell. And then it also ties into things like semiconductors, which ties into tech, which ties into the monsters of tech, the FANG names. So seeing crypto up in the pre-market is bullish for the market. And I was just about to say, I'm not seeing these proxies looking very bullish at all. The semiconductors, AMD, NVIDIA, sure, no problem. And then some of the bigger names, blockchain related, like Riot, also, yep, looking really good. But these Bitcoin proxies like BT, GBTC, that's a big proxy for Bitcoin. That's not up very much this morning. BITO, this is like a Bitcoin ETF. That certainly doesn't look good. That's the same flag that we were just talking about in the S&P. Now, depending on how you want to draw it, if you use the wicks, don't use the wicks. We either are already at that 786 if I took the wicks off, or we're not quite there. But that's about as far as a pullback as you'd want to get. %52 of the S&P is up this morning, 0.5%. That's the bullish we've been in, gosh, weeks. Can't remember the last time I said something like, oh, we're up, half the market is up this morning. $20 names are up more than 1%, which is, it's not too bad. We are looking at the S&P, so we should see names that are connected to finance, USB, American Express. So, we do have a few of those in there. MetLife, AIG, so some insurance stuff. It's still finance. Finance, energy. We got the semiconductors in there. Seeing a lot of the FANG names, Meta, Google, AMD. I'm still choking on that, but it is in the FANG, NY FANG list. And Tesla. But 50% of the S&P is up this morning. %52 of the NASDAQ is up this morning. And if you're thinking, well, yeah, duh, if S&P is up that much, so is the NASDAQ. We could do it that way, but well, the NASDAQ doesn't represent financials. The NASDAQ 100 does not represent financials. So all those financials that were up in the S&P, they're not here. They have to be replaced by something else to still see half the NASDAQ up this morning. I see a lot of semiconductors. And of course, the FANG names. But there's also some casinos, some pharmaceuticals. And remember, we're looking for a theme behind it, right? This rising tide argument at the moment. So we want to see a broad spectrum, a wide swath of sectors up. We don't want to see it all piled into K-Web and Bitcoin proxies. And all those short squeezes that we were getting, we haven't gotten those in a while. Basically, they're about done with this, getting those. So that sums it up really well. A little weak in healthcare and some retail that is a little laggy. Transportation seems a little soft, but otherwise we got a broad swath representation across the market, and it's not overly extreme, right? Nvidia 1.5, Google 1.25, Facebook 1%. Okay, those are kind of reaching a little bit in the pre-market, but it's not like 2.5%, 3%, because I'd be looking to short this sucker if we were up that much this morning, and we're not. So Tesla, yeah, that's up a little much, but not too much, right? Otherwise, this is looking like we could easily rally today. So the thing about these trend days, and I've got new content coming out on my trend days because I got tired of having the same old discussion when it comes to the idea that just because you see trend doesn't mean that it's going to be one of our 4 trend days. And I finally come to the conclusion that the confusion that people have is that they're called trend days. So if I had called them our 4, I don't know, happy baseballs, then nobody would have been confused. Baseball number 1, baseball number 2. There'd have been no confusion, no doubt, no hesitation at all. Instead, we called it one of our 4 trend days. Then everybody would say, well, I see trend here. Isn't that a trend day? It was a day that was trending. It's not one of our 4 trend days. So new content is going to be coming out to reshape that. Why am I bringing it up? Well, because there's something different that actually is called a trend day, and it has none of the same qualifications as the old stuff. One of those qualifications is that we gap up in the pre-market, and as we come into the open, we don't fill that gap, and we continue to expand farther away from the gap. That's really about all of the qualifications to it for it to be one of those trend days. It doesn't matter if it's inside yesterday's range, it doesn't matter, nothing else. We have the criteria this morning for one of these trend days. And the reason it's so important to recognize one of these trend days, because think about the problem with a trend. Why did it start? How long has it been going before you finally recognize that it really is a trend? And when is it going to end? And inevitably, when there's a trend going, by the time you realize that it's a trend, you're thinking to yourself, oh, it's already gone so far. There's no way I can trade it now. And it keeps going and it keeps going and it keeps going. And then you're thinking, why the heck didn't I get in that thing? But no way I can get in it now. It's even farther than it was. So you don't get in and it keeps going and it keeps going. And when you're finally convinced that it really is just going to keep on going, then you get in and then it runs you over and it stops going in a trend and it goes the other way. Sound familiar? So the difference between that and what we're talking about is when you know that it's, quote, a trend day, it's one of those days, and you can see it coming from the pre-market before the bell even rang. It's going to be one of those days that you can stick the trade, stay in it, just keep on running it. That you can say you take profits, get out, and decide you're going to get back in it again because you know that it's not done going yet. So you can come back in and get another bite of the apple. There is a trend day checklist. This is not a new list. I've done videos on this that you can find, right? All you got to do is search on YouTube trend day checklist. You'll find my old video. So we're looking for a pre-market gap and a market that does not come back down to close that gap. And if the gap is more than 0.5% wide, better to be closer to 1%, but even still, more than 0.5%, a lot of times the market won't get that gap closed. So where's the close from yesterday? Just go to a daily chart, mark the close. There's your close from yesterday. While you're out there, you can also, mark the open, high, low, but really the only one you need is the close. So the question becomes, are we going to fill this gap before we continue to go higher? And if we don't, if it starts to try to fill the gap a little bit, and then it just turns around and it continues to go up even more away from the gap close, that's the last piece of the check for the checklist. And you run that sucker. We already got the levels. 40.50, 40.85, 40.73. Now you do want to have a little bit of caution because we have a pre-market high in the Globex. And this is a trade that I've been doing a lot lately and I love it. Here's an example of it. So you set a high in the pre-market and you pull back off of that high. And then we come into the intraday and we run up and we tag that high, fail to get through it. And there's the setup for your short. It's a great short. I love it. I wouldn't try to do that today, by the way. It's kind of the point. Today's very likely going to be a trend day. All of the conditions are met except for opening and not closing the gap. That's the last one that hasn't been met. So the number one thing for resistance right now, or that would kill this trend day idea today, is if we come up and we fail to get through 40.40, which I've got marked is a significant level of resistance. Critical resistance, 40.39, right there. So when we get into RTH, we make a run for that high. Maybe we fight there a little bit. When we finally get through it, it's game on. That's the only thing holding us back from a trend day. And trend days can get 1.8 to 2.5%. Right. So when you're looking at change percent on the day, in the S&P, it normally runs in 25s. So if we get to 1.9%, feel pretty confident we're going to go to 2%. If we get to 2.1%, maybe 2.15, we're pretty confident we're going to go to 2.25. The average daily range right now is 1.9%, and I'm going to round that down to 1 3/4. If today's a trend day, we can easily double the average. If I called it 1 3/4, then we could say that's 3.5 doubled, right? So a 3% move today, it's not off the table. We can do that. We just got to be very careful of these levels that I mentioned, because they are critical levels. 40.85 is the last one. Some of the things that we would want to see for a trend day in the current market, we really want to see bonds either just hold steady and really not move around at all, or we want to see bonds break down. I'd like to see them break that 129.5. So these are fractional notion value. It's 1/32. So half would be 1/16. And I know, they're not reduced, and don't even squish your head on it, right? Just 1/16. So you can see it's 20, 19, 18, 17, 16, 29/16. That's half. I'd like to see it get down to that and then break this low, continue to push lower. That'll really fuel this trend day. We don't want stocks and bonds moving in the same direction today. The other thing is going to be those 10-year yields. That's going to make this bond talk a little tricky. Yields, we don't want these things getting up, say, above 4%. And we're not there, right? It's no big deal. It's at 3.5. So they're likely going to rise with the S&P if the bonds are falling. But that's fine as long as they don't rise too much and say start getting above 3.7. So we don't want to see them get this breakout, right? They need to stay underneath this level, 3.65. So if the bonds, like I had originally said, if they just hold still, not really move around, not break down, not rise, not fall, just kind of hold the line, then yields will hold the line and gives us free run. I'd like to see that VIX get below 20. I'm looking at the VIX futures at the moment, but we can swap over to VIX. So VIX itself is already below 20. It's at 9. We want to see it get below 19 and preferably 18.5. That'd be good. You see VIX below 18.5, we could see the S&P easily get up into that 4,100. We're just now coming into contact with VWAP again. So if you're looking at this pullback, in concern, yeah, I mean, we were due a pullback. And we're just getting to VWAP. So it's not a significant pullback yet. So we've talked bullish all morning, and I'm pretty confident with the idea that today could be a trend day. Just 786, right, is that level of concern. And now it's time to discuss what if. So what if we break below 40.26 and things get negative and we start just running back in the other direction? 40.26 is the first level to focus on, and then 40.11, the cog line. Past 40.11, we've got the open from yesterday, or I should say the close from yesterday, excuse me, 40.06, that's the close. Then we want to focus on the Globex high of yesterday. It's really close to 4,000, which makes sense. We just focus on that round number. And then the low of the day, 39.80. So 40.23 is that line in the sand for a pullback. We really don't want to see it pull back more than that. If it does, it kills the trend. Now, just because it kills the bullish trend doesn't mean we're bearish by nature. It just means we're no longer in a bullish trend. We would still need to see a bearish signal before we'd want to short this sucker and run it back down. Because we could just stall out and chop up here for the rest of the day, maintaining somewhere between, the top 40% of this run. And we could just chop right there for the rest of the day. So don't get all bared up if we break 40.26 and get below that 786 trend line or fib level. That doesn't immediately make us bearish. And since if we did get bearish, we would get all the way back down to 39.80. There's plenty of room. There's no reason to, think you have to short it immediately. There's plenty of time for it to convince you that it's really headed to the downside. If we get bearish, everything's going to have to get bearish. We can't have anything fighting this. So NY Fangs would have to, they're going to open gapped up and really big. They're going to have to close that gap. KRE, which is already gapped up, would have to close the gap, challenge yesterday's low. We would want to see the advanced decline in the NASDAQ and in the S&P at the very least get back to zero, because they're going to open, gapped up and really high. Just getting to zero on those would be a good start. We'd want to see the ticks pressing multiple occasions below 1,000. That'd be the negative 1,000. So we'd want to see it in the red, tagging, minus 800, minus 1,000 multiple times. And we want the weighted AD to get below zero, because it's going to open gapped up, or it's going to run up really high, really fast. So if we get bearish, there's a lot of signals. You don't have to, just rely on price alone. We would want to see bonds start to rally, or we'd want to see the 10-year yields maybe get above 3.7, start to make people a little concerned about, the 10-year at 4%. That would do it. Otherwise, we are primed and ready and aware that today absolutely could be a trend day. Everybody, I hope you have a good day. Be careful, be safe. I'll see y'all tomorrow.